The impeachment of Donald Trump is now looking like a possibility, but the key question is what's that going to do to global financial markets? And in particular, what effect will it have on the trade war dynamics, which have already started to weigh on the global economy and on financial markets? So let's look at that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. The timeline for the impeachment starts in July 2019. Now, sometime in July, Trump suspended security assistance to Ukraine. Then on July 25th, Trump had a phone call with President Zelensky of Ukraine. On August the 12th, a whistleblower from the US intelligence community delivered a complaint to the chairman of the House Intelligence Committee and the Senate Intelligence Committee. And the Democrats have decided to use this as grounds for impeachment. And there are reports that they aim to do this before Thanksgiving in 2019. The reason for the time constraint isn't that there's a time limit on impeachment, there isn't, but the Democrats will want to complete the process before the presidential election in November 2020. So now let's look at what happened and also details of the whistleblower complaint. This is the redacted version of the phone call which has been released and is available on Wikimedia. First of all, Trump asked Zelensky to look into the situation with CrowdStrike, which was a private company that looked into leaks of emails from the servers of the Democratic National Committee. But then more controversially, Trump says there's a lot of talk about Biden's son. And of course, Biden will be running against Trump in the 2020 election. He says that Biden stopped the prosecution and that a lot of people want to find out about that. And then he asks Zelensky to do whatever he can with the Attorney General. The actual whistleblower complaint is also available in redacted form. And one of the key points in the document is a concern that the President of the United States is using the power of his office to solicit interference from a foreign country in the 2020 US election, and that Trump is doing that by pressuring a foreign country to investigate one of the president's main domestic political rivals, and then goes on to say what laws he thinks that breaches. He also has concerns that these actions pose risks to US national security and undermine efforts to counter foreign interference in US elections. The first stage in the impeachment process involves the 6 House committees making submissions to the House Judiciary Committee. If that finds sufficient evidence of wrongdoing, it'll be passed on to the House of Representatives, which then votes on articles of impeachment. If insufficient evidence is found, then Trump will remain in office. If the House does vote on articles of impeachment, it just takes a simple majority, 51%, to support impeachment. Then Trump will be impeached and there'll be a trial in the Senate. Then once a trial is complete, the Senate votes on whether to convict the president. And that takes 2/3 of the Senate to vote to convict. If they don't reach 2/3, then Trump will remain in office. And if it does reach the 2/3 threshold, then Trump will be removed from office and the vice president will take over. Here's a statement from the Democrats in the US House Committee on the Judiciary. They say that the transcript is an unambiguous, damning and shocking abuse of the office of the presidency for personal political gain. And that's because the president abused his office by directly and repeatedly asking a foreign country to investigate his political rival. And to open investigations meant to help the president politically. Whereas Doug Collins, who's a Republican and ranking member of the House Judiciary Committee, says that the transcript reveals that Democrats have again leapt to conclusions before looking at the facts. There was no quid pro quo and nothing to justify the clamour House Democrats caused yesterday. Now, the reason why the impeachment looks quite likely is because in the House of Representatives there's a Democrat majority. However, the Senate is dominated by Republicans, so it seems quite unlikely that they'll support conviction of the president. This isn't the first time that a US president has been impeached, and that means we can look at precedents of impeaching presidents. After the Watergate scandal, President Nixon was impeached in the 1970s. The impeachment process began on October the 30th in 1973, which I've marked here with a red bar. And the graph you can see here is the S&P 500. Notice how it was already on a steady decline which had started at the beginning of 1973 because of some severe economic problems that the US was experiencing at that time. On February the 6th, 1974, the House of Representatives passed a resolution which gave the Judiciary Committee authority to investigate grounds for impeachment. And then by the end of July that year, the Judiciary Committee approved 3 articles of impeachment. Given the damning evidence, it's quite likely that Nixon would have been removed from his role as president. So he chose to resign on August the 9th, 1974, before that could happen. Now it's hard to say whether this decline in the S&P 500 was exacerbated by what was happening with the impeachment, but it certainly didn't help. And once Nixon resigned, the S&P turned a corner, so that by the beginning of 1975 it started to rally. But part of the reason for that fall in equity markets was a recession, which started at the end of 1973 and then ended at the beginning of 1975. Unemployment started at around 5% in 1973, but once the effects of the recession started to be felt, as is often the case, unemployment increased rapidly all the way to 9%. It's interesting that this recession, which is marked by the grey bar, was predated by an inversion of the yield curve. So if we take the 10-year borrowing rate for the US government and subtract the 3-month borrowing rate, normally that's positive, but when it turns negative, the yield curve is said to be inverted. And people have noticed that that often occurs before a US recession. Commodity prices were also moving very rapidly during this period, and oil in particular had a huge price surge due to an oil embargo in the Middle East. And that had severe negative impacts on the US economy, which was very dependent on those imports. This also marked the end of the gold standard, where the US dollar and other national currencies were pegged to the value of gold. When the gold standard ended, the price of gold in US dollars started to rally very quickly. So we could probably argue quite convincingly that this fall in the S&P 500 was more to do with the economy and less to do with the impeachment of President Nixon. President Clinton's impeachment had to do with his alleged affair with Monica Lewinsky. And that impeachment took place at the end of 1998. However, just before that occurred, we had the Asian crisis. And that caused some quite severe volatility in the US equity market. So for example, on October the 27th in 1997, the S&P fell by a huge 6.9%. And that fall was so severe that the New York Stock Exchange halted trading. The reason for that is that it gives people a breather. They can calm down and hopefully markets will stabilize. But on the whole, this period running up to the impeachment of President Clinton was a fairly stable one. The economy was growing fairly strongly, unemployment was low. The actual impeachment process started on December the 19th, 1998, which again I've denoted with this red arrow. Then in early January 1999, the Senate trial began, and by February 12th of that year, the charges were defeated. So the whole process was very quick, and you can't really see much of an impact on the S&P 500. And here you can see why. Unemployment was fairly low in 1999, less than 4.5%, and it was still falling, and gross domestic product was powering ahead at over 4%, which is very high by today's standards. So here again we can see that what happens with the economy is much more important than what happens with a presidential impeachment. So if those are the precedents, what's different this time round? One of the primary differences is the fact that Trump has launched a trade war against China. Chad P. Bown of the Peterson Institute has written an excellent article called The US-China Trade War, The Guns of August. And he shows how the average tariff has increased rapidly over time, such that by the end of 2019 it should reach about 27%. And at the same time, the coverage of Chinese imports should rise to almost 100%. Now this has had a huge impact on financial markets. Generally, when the trade war looks like it's getting worse, or there's a ratcheting up of the rhetoric, equity markets sell off, gold rallies, and so do treasuries, which is a typical risk-off move as people de-risk their portfolios, moving from riskier assets into safe haven assets. Then when it looks like there's a breakthrough in the negotiations, equity rallies and treasuries and gold sell off. So it's clear that the equity markets want to see a resolution of this trade war. The Bank of England's inflation report has made it very clear that the trade tensions are likely to have affected the global economy, both directly and indirectly. The obvious effect is that Chinese imports from the US and US imports from China have fallen, but the wider effects on the global economy have been through reduced business confidence. The manufacturing sector has been particularly hard hit, and that in turn has weighed on investment. And the Bank of England thinks that's the key driver of the recent slowdown in advanced economy growth. The Bank of England even assigns numbers on the effects. They say that tariffs are projected to reduce GDP in the US by 0.5%, and in China, slightly less by 0.4%. That lowers purchasing power parity weighted world GDP by 0.2%. Now, as of October 2019, the US economy is still strong. As Jerome Powell says here in his September 2019 FOMC press conference, he points out that the US is in the 11th year of this economic expansion and the outlook still remains favourable. Okay, growth isn't great at 2.5%, but household spending is still strong. And that's been the key driver of growth. And in turn, that's been supported by a strong job market, rising incomes, and solid consumer confidence. But this is probably what's irked President Trump when Powell says that business investment and exports have weakened amid falling manufacturing output, and that the reason appears to be slower growth abroad, but also trade policy developments. In other words, Trump's trade war. And these two sources of uncertainty are something that the Fed is monitoring very closely. Now, markets took a bit of a hit in October 2019 when it looked like the data for services were also starting to weaken alongside manufacturing that had already suffered. Here you can see the US version of the Purchasing Managers Index. It's called the Institute for Supply Management Non-Manufacturing Index. And when it's above 50, it shows that the non-manufacturing sector is expanding. Below 50 shows contraction. And since September 2018, you can see this gradual slowdown in this non-manufacturing ISM. But it's still above that critical 50 mark, which shows that there's expansion. This is what Chris Williamson, who's a chief business economist at IHS Markit, which produces the Purchasing Managers Indices, has to say about it. He says that the past 2 months have seen one of the weakest back-to-back expansions of business activity since 2009. And in turn, that means that GDP will probably slow down in the third quarter of 2019, with further loss of momentum in the fourth quarter. Here you can see the manufacturing PMI in dark green and the services PMI in light green. Notice how manufacturing falls first and then it's followed by services. And that's what's really spooked markets because the services component is much more important. Well, why has it fallen? One of the primary reasons is that inflows of new business have almost stalled, with those inflows seeing the smallest increase since 2009. In turn, that means that companies are being more careful about spending on payrolls, and that's led to a net drop in headcounts for the first time since the global financial crisis. And in turn, that means that non-farm payrolls will probably trend below 100,000, which is about the minimum number you need in order to just absorb the new entrants into the jobs market in the US. And when non-farm payrolls goes negative, that's almost always followed by a US recession. So this non-farm payrolls number is a critical thing that you should be aware of. It's published every month, and I talk about it in my newsletter, which, by the way, is completely free. And you can find a link to it in the description. Another worry is the yield curve inversion that we saw before. When this orange line goes below zero, it usually means that there's going to be a recession shortly afterwards. Sometimes you get a false positive, as you did in 1966, but for the past 7 recessions it's worked fairly well. And as you can see in 2019, there was another inversion. The Cleveland Fed has this model which predicts the probability of a recession in the coming year based on the steepness of the yield curve. And currently that probability is running at about 40%. But that model isn't based on a profound economic theory. It's just something that people have noticed. When yield curves invert, shortly afterwards there's a recession. And really there have only been 7 data points since 1970. But the story for now is that gross domestic product is still holding up in the US. It's still well above 2% and quite a long way from recession. And while non-farm payrolls isn't as high as it's been in the recent past, at around 200,000, it does seem to be sloping off, it's still in positive territory. So it's certainly not time to panic about the US economy going into recession quite yet. But you should definitely be monitoring these indicators like non-farm payrolls. So I think it's very unlikely that President Trump is going to lose his job because of this inquiry. There just aren't enough Democrats in the Senate to carry the vote. But what's very clear is that equity markets don't like this trade war, and anything that makes it less likely to continue, perhaps because Trump won't be re-elected and his successor doesn't have a taste for this trade war, then that would be seen as a positive for the equity markets. But as always in politics, these things are impossible to predict. Now, if you found that video useful, please support us on Patreon. We rely completely on you for our support. It costs just $5 a month. Click on the button above to subscribe, and then you can join us on Slack and on our Sunday evening live call when you can ask anything you like. And as always, thank you for listening.